All right.
Good afternoon, everyone. Thank you so much for joining today's Next Partner webinar series on 409A valuation. Really excited to have everyone today, and we are blessed to have Lerone Sharon of YMS Value. I'll introduce Lerone in a minute or two. It's a crucial topic. We get questions about 409A valuations all the time. So really lucky to have Lerone here today. So a few housekeeping items. Feel free to put your questions in the chat. We will either save them for the end or we can interrupt Lerone if it's more timely. Happy to do that. Next, as many of you know, is an innovative model for the delivery of legal services to startup and emerging growth companies. We operate in a fixed fee environment, creating a broad variety of fixed fee legal packages for our startup clients. We are very involved in the startup ecosystem, and our Next Partner webinars are just one way that we provide value add to our clients. So again, we are really excited to have Lerone Sharon of YMS Value here today to discuss all things 409A valuation. Lerone is the founder of YMS Value, a business valuations and consulting firm. YMS Value specializes in performing valuation analyses for various purposes, including for compliance, tax, M&A deals, employee stock options, fundraising, and litigation and dispute matters. YMS also provides M&A pricing and forecasting services, and the firm's clients span a range from early stage startups to large multinational corporations. Lerone is a certified public accountant from Israel, earned an MBA from Texas A&M University, and is an accredited senior appraiser by the American Society of Appraisers. So without further ado, I would love to turn over today's partner webinar to Lerone, and thank you all for joining us today. Lerone, it's all yours.
Thank you, Lisa, and thank you, Next, and thank you for everyone joining us today. I like Lisa said, it's an important topic, and I'm happy to share insights with you. And by the end of the day, the goal is for you to be more knowledgeable about 409A valuations. So let me share my screen. Lisa, please let me know if you see it.
Okay. All good. Yep, you're good to go. Thank you.
Thank you. So so during the presentation today, we'll discuss why 409A valuation is needed, the role of the appraiser, and discuss the valuation analysis process. So those are the main goals for today's presentation. Stock option granting, it has been around for a very long time, obviously a few decades now. Stock option is the right to purchase a stock or any other underlying asset in the future for a fixed price. And in the context of stock options for employees, it has become a very important tool to recruit employees and to retain employees. And it's very common these days as part of compensation package that employees seek. So that's why it's very popular, and the issue arises fairly often. The compensation via stock option is defined as deferred compensation, with 409A plans being non-qualified. Deferred means that the tax is not paid when the options are granted, rather when they are being exercised. However, in order to be able to defer the payment, there are certain conditions that needs to be met. We'll discuss them shortly. 409A plans being non-qualified means that the underlying asset is the company's security. There are qualified plans, for example, 401k plans that it's pretty much a trust where employees put money in securities that are not the company's securities. So that's a difference between qualified and unqualified, but they're both deferred. Internal Revenue Section 409A, which will be, our topic, passed as part of the 2004 American Jobs and Creation Act. So pretty much in 2007, the IRS issued regulations for the treatment of the 409 plans, and all non-qualified plans must comply with Section 409A rules in order to retain the tax-deferred status of the plan. Otherwise, there will be potential penalties and tax payments that will be assessed on the employees, and that's something obviously that we would like to avoid, or you would like to avoid. So in order for the recipient to defer the tax, we need to make sure that certain conditions are met, and one of them is that the fair market value of the underlying security is not higher than the exercise price of the option that is being set in the grant document. So that's one of the conditions, and that's a very, very important one. So this is just a simple numerical example. So you see the strike price in red. The strike price is also known as the exercise price. This is the price in the future where the option can be converted to the underlying security. In the green, we have the stock fair market value. In order to retain the safe harbor status, options cannot be in the money on the grant date, meaning the stock fair market value has to be at least as high as the strike price, if not lower than that. So those situations where the option is being granted in the money, that's the situation we want to avoid. So in that numerical example, if the exercise price is 5, if the underlying security on the grant date is 6, being higher than the exercise price, meaning the stock is in the money, the option is in the money, that is not good. We need the option to be, or the exercise price of the option to be, either equal to the fair market value of the underlying security or lower than it. And many times it's being structured to be similar, meaning the exercise price is being set based on the fair market value of the stock. It doesn't have to be like that, but that's usually an optimal situation because it's easier that way to actually gain benefit from the option granting. So one of the questions that I receive, I assume Next receive as well, is, I'm a small business right now. I don't have too many employees. I don't grant too many options. What are the chances that I will be audited one day? Do I really need a 409A valuation? And the answer is yes, you do want that, because one day the IRS might come knocking on your door, or the company will grow and you will need financial statements based on US GAAP, generally accepted accounting principles. And this is an expense that you will need to account for. So you really don't want 3, 4, 5 years after the fact to have to go back and do those type of analysis for various reasons. One, and probably the major one, now you will have to go back in time and think about what happened in the business 3, 4 years ago. What were your projections? What was the trajectory of the business? Did you have, future financing rounds known at this time? It's much more difficult to collect the relevant information that is needed to conduct the analysis at this point. This is a headache that you will have to deal with, because likely you will be there when that issue will arise, and the people working with you will come to you to get your inputs. It's obviously going to be also more expensive, and it will be subject probably to more scrutiny because hindsight valuations, even though definitely possible and I've done them in the past, now you're dealing with, okay, did I really know that or didn't know that back, a few years ago when, the options were granted. So to make a long story short, it is better to do it when the options are granted, and also obviously you assure that you won't be in a situation that you grant options that are in the money. Okay, that's obviously the key. You don't want to go back in time and find out that you actually granted options that are in the money. So for all those reasons, if you grant stock options to employees and you're subject to Section 409A, and you want to be sure that you have a safe harbor status, just do the analysis when you grant the options. For a privately held company, you really 409A valuation is the only way to go. I mean, a public company has traded securities, so when the company grants stock options, it knows what the market value of the underlying security is. For public companies, that fair market value has to be determined. And that's the reason. Now, the IRS doesn't have any mandatory certifications for an appraiser to perform 409 evaluations. However, it does require the appraiser to have significant knowledge, experience, education, and training. Meaning the appraiser needs to have enough knowledge, enough experience in doing those type of analysis. And one thing that is not mentioned here, but it's part of any IRS requirements for an appraiser, the appraiser has to be unbiased and not related to the entity. So when the appraiser issued the report, it is specifically noted that the appraiser certify that the appraiser does not have any affiliation with the entities, does not have any interest in the entities involved in the security that is the subject to the analysis. There are other situations where the IRS is more specific, for example, for charitable contributions. And in those cases, the IRS specifically indicate, specific, for example, appraisal designation from a recognized professional organization such as the ASA or the NACVA, and regular prepared appraisal in the subject, for the subject asset, etc. But it's a little bit more broad for 409As, but it does give an indication as to what the IRS is looking for. Lastly, I would say when you do engage with an appraiser for a 409 evaluation, you will get an engagement letter from the appraiser, and the engagement letter should include at least, certain information that, you need to make sure that is satisfying your requirements. First and foremost, it should indicate that the valuation is for, 409A purposes to comply with IRS requirements. It should indicate the valuation date. It should indicate the underlying asset being valued, and obviously timing and fee. And there are a few other things, but those are probably the keys. I would highly recommend to go through the engagement letter and just make sure that you're getting what you need. In terms of the timing of the valuation, the IRS realizes that it's nearly impossible to do evaluation on the grant date. So let's say that you're granting options today, May 2nd. It's almost impossible to do evaluation today and then issue the relevant documents. So you have probably at least 2 months between the grant date and the valuation date. So if we do the analysis for a grant date today, as of March 31st, that should be fine, as long as there were no significant changes in the business. That can include technological advances, that can include for example, company that didn't have revenue, started generating revenues, engagement with a significant client, etc. So those type of things might create issues during the time gap. But otherwise, you probably have about 2-3 months. I would say probably don't stretch it more than that. So try to make sure that you're within that 2 months time frame between the valuation date and the grant date. So now we'll transition to how exactly the analysis is being done. But Lisa, are there any questions you think should be addressed so far?
Nothing in the chat, Laron. If
Okay.
somebody has a pending question and wants to ask it now, feel free to unmute yourself. Otherwise, add it to the chat and we'll continue.
Okay. All right. So yeah, we can. If there are any questions that you would like to be addressed, just raise your hand virtually, and I'm happy to address questions as we go. I know that sometimes half an hour passed by and you don't even remember what you wanted to ask. So I do want everyone to feel comfortable. There are 3 steps in performing Section 409A valuations. The first one is value the equity, the value of the equity of the company. That's let's think about it as a pie. The second phase is to take that pie and split it between the different share groups of the company. So let's say a company has preferred A, common, and existing options. The value of the equity of the company is split between those groups. And it's important because we'll discuss soon how you do that breakdown and how you derive the value of the under asset from that. The third step is to consider the liquidity issues that are associated with owning a security of a non-publicly traded company. So privately held companies do not have the same liquidity for their securities as our publicly traded companies. That's why we apply discount for lack of marketability to determine the fair value of the underlying security as of the analysis date or the grant date. Obviously, what we value is the underlying security that the option is applying to. So as mentioned, the first step is the equity valuation. And generally speaking, there are 3 main methods to value a business or an asset even. Income-based, market-based, and asset-based approaches. In the process of doing the analysis, all applicable approaches has to be considered. When the appraiser is doing the analysis for 409 purposes, we specifically indicate that those are the methods that we considered and which we applied or didn't apply, and the rationale as to why. Obviously, each of those methods we can spend just as separate webinar just to discuss them, but we'll do it briefly because I think it is important that you understand the valuation process and you're more knowledgeable about the product that is being received at the end of the day. So income-based methods, the major one is the discounted cash flow methods. There are other methods. We'll discuss one of them shortly, later. But the DCF method, discounted cash flow method, is definitely the most widely used, and it is basically taking future cash flows and translating them to a single current value. And the estimation of future economic benefits is based on the stream of those future cash flows that will be received. Usually, we have a projection for a time frame of 5 years, and then we discount that back. We'll elaborate on that. Now, the DCF method is forward-looking as well as inward-looking. So some methods, for example, multiples, which will be discussed later, many times use trailing 12 months data to derive the implied value. The DCF method is really looking at the future expectations for the business, and it is also looking at the specifics of the business. The projections that are being used can be built top down or bottom up, meaning top down starting with the revenues and then apply certain percentages to forecast the expenses, or build the expenses specifically and building it upwards. But either way, those are very specific to the business that is being analyzed. Obviously, the flip side of that is that the method is really dependent on the quality of the projections that are being made, because projections that are not realistic will skew the results of the valuation. So it's very specific to the company, which is a plus, but also obviously there is this disadvantage. So again, when you're working with an appraiser, make sure that the projections that you use for the analysis are realistic, and be consistent with the projections that you use for other purposes. I mean, you don't want to have a few sets of projections, and one that you present to certain groups and one to the others. I mean, we definitely want to keep things consistent. So the first step is projecting the cash flows, as mentioned. Usually it's for a period of 5 years. It can be less than 5 years. It can be more. And one of the considerations is also, once we get to the last year of projections, what do we think will happen later? So there is the terminal value issue that we'll address, but usually it's for a period of 5 years. The projections should be adjusted for non-cash expenses, for example, tax depreciation, tax amortization, capital expenditures or purchases of fixed assets, computers, furniture, leasehold improvements. And in case that the projections are being prepared based on US GAAP, again, that's generally accepted accounting principles, unlike cash projections, they should also be adjusted for changes in working capital. Working capital is the accounts receivable, payables, and inventory when relevant. Again, for cash projections, this is not relevant because the projections are on a cash basis. When it's on a US GAAP basis, we do try to, revert back to the cash flow that the business will generate. So it is possible that the business will show loss on a US GAAP basis, but on a cash basis will actually show positive cash flows. That's why it's very important. So this is a very simple example for a discounted cash flow. The valuation date here was December 31st, 2021. As you can see, the revenues, this is not a super early stage company, but still, a tech company that is growing fast. I can tell you that it has grown fast also in the previous year. So the growth definitely is, wasn't unreasonable here. We have the revenues, cost of goods sold. Not all the companies have that. In that case, that's paying for service providers as well as other, let's call it internet sources. I think Google was involved there, etc. And then we have the administrative expenses, sales, marketing, admin, etc. You can see that in the first year, the earnings before interest, tax, depreciation, and amortization was actually negative, so a loss was expected. We subtract tax depreciation. It's tax. It's not GAAP depreciation because we're looking for the cash flows. You can see that for tax purposes, in the first few years, because of accumulated losses, the company wasn't expected to pay tax until 2023. And then you can see the adjustments that we discussed. So we bring back the tax depreciation because it's not really a cash expense. The cash flow was actually paid when the assets were acquired. We do consider those capital expenditures, so mostly computers and furniture. And since that company is reporting based on US GAAP, we made adjustments for working capital. Now, the adjustment here is pretty significant. That company operates in a SaaS model, so they collect before they actually provide a service. So even though they cannot recognize the revenues in certain years, only in the future, they basically receive the money ahead of time. And that's why, again, in terms of cash flows, the cash flows are actually better than the profitability based on US GAAP. So if we had those projections prepared on a cash basis, we would actually see, those higher numbers, to begin with, because revenues would have been reported on a higher level. So after we,
Lerone, real quick,
yes,
before you go on, we do have one question in the
sure,
chat. How do you account for equity cash injection from the founders for capital expenditures?
So where the funds are coming from is actually not important for the purposes of the equity valuation, because it can be based on that. It can be based on available cash that the company might have, or yes, in the future it might be needed for the founders to infuse more cash into the company. That is actually not directly affecting the cash flows. That can affect two things. One, it might affect the discount rate that will be used to discount those cash flows. We'll get to it in the next section. Because that reflects potentially a higher risk for the company. So if the company will need additional funding in the foreseeable future, that's an additional risk that will have to be considered. The other place where it might be considered, if it's known as of the grant date or as of the valuation date that future funding will be needed, that might actually will have to be factored into the split that we do of the equity value between the different share groups. When we'll get that, maybe I'll explain how it's being done there. But basically, when we do the analysis of a specific date, we also have to consider, future changes to the equity structure of the company if it's known as of the analysis date. Any other questions there? Okay, so we can continue. So like I said, projections for a period of 5 years can be sometimes longer, sometimes shorter, but obviously the business doesn't end there. The assumption of an ongoing business is always that the business will continue into perpetuity. So how do we factor in those future cash flows beyond the projection period? There are a few methods that are being used to value the company beyond that point. The most common ones are the long-term growth rate method, the Gordon growth model. There is also the two-stage model or the exit multiple. Basically, what is being done is taking a representative cash flow that is being derived from the cash flows of the last year, and then discounting that into perpetuity, and that gives us the value, and then back to the present, and that gives us the value of the company beyond the projection period. So we'll have the value of the equity will be derived based on the 5-year projection plus the terminal value of the company beyond that point. After we do that and we get a value of the future cash flows, we just have to account for non-operating assets, for example, cash, investments, marketable securities, subtract any financial liabilities that the company have. Please note it's financial liabilities, not operational liabilities. So financial liabilities, loans, a bank overdraft. Operational liabilities include payables, for example, and that's part of the working capital, the net working capital. If the net working capital of the company, again, this is for US GAAP prepared financial statements. If the net working capital of the company as of the grant date or the valuation date is representative for what the company should have, then we don't do anything beyond that. If there is excess or deficit, which I should say usually should be not be the case, then it's also the excess or deficit are also being incorporated into the value of the equity. So we'll have the value of the cash flows plus any non-operating assets minus any non-operating liabilities, and plus minus any excess or deficit in net working capital. So the discount rate, and that's really important. So the future cash flows, and we talked about the projections. So the projections, we work with the best projections we have, but projections comes with some risk, and the discount rate that is being used to discount back those future cash flows to the present represent really the rate of return required by the investors in that business, and it's also being referred to as the opportunity cost. So the investor has a few options. Investing in U.S. Treasuries is considered a risk-free investment, unless you think that the U.S. government will default. That you're putting the money and you'll get your coupons, and at the end of the life of the bond, you'll get the principal back. You have obviously investment in publicly traded companies that also comes with certain risk beyond that risk-free rate. So each investment has a certain risk, and for early stage companies, the risk is very high. There is a lot of uncertainty, and the discounts that are being used are really the venture capital rate of returns. Now, if the company is more mature and has more of a track record and the risk is more measurable, then the appraiser would apply the weighted average cost of capital. I don't know if you heard that the term or not in the past, but it's taking the cost of equity and the cost of debt of the company, and obviously I won't get into the techniques, and then getting the rate of return that an investor would require. For early stage companies, we just use the venture capital rate of return. And these are some of the the research that was done in the past, and those are pretty acceptable ranges for companies in different stages of development. So you can see that at the startup level, we're talking about 50 to usually 70%, early development 40 to 60. and second stage expansion 30 to 40, 45 usually. When you get to close to an IPO, you can actually apply the weighted average cost of capital, and at that point 25% is probably about what you would expect to see. And I should obviously know that usually there is no debt component for those type of companies. Maybe before the IPO there is, but before that it's 100% equity. As I mentioned earlier, there are a few other methods that are being used, as part of the income method, if you would. But one of them is the capitalization of earnings. That method is really applicable when you have a stable business. When you have a business that generates about the same revenue, same profits year in, year out, and you do not expect any significant changes, there are no unique needs in terms of expenditures, you can just do one standardized year and use one of the methods that we discussed earlier for terminal value to extract the value. So instead of doing 5-year projections, which would look about the same, you just use 1 year. As I mentioned earlier, this is only for stable, profitable companies, and this is not applicable to early stage companies, or any other company that is experiencing changes in growth or profitability over time. Now we'll discuss the market-based methods. There are two main methods there. The Guideline public company method is one of them, and the more widely used. It's pretty much measuring the value of an entity based on what the market is willing to pay on other similar assets. The main challenge here is really to find Guideline companies that are public and are similar to the entity that we're valuing. I would say most of the early stage companies I've worked with, it's really, really difficult, at least until they get to a more mature phase, because usually the public companies are much bigger, much more diverse, and many of the risks involved were removed. And it's not always fine to find companies that are in the same space, providing same solutions, and can be really compared to the company that we analyze. But this is something that we try to do, at least to get some sense as to what the market multiples are, just to see, in terms of, let's say our terminal value, how it is, in terms of a market exit multiple, or in terms of the volatility of the assets that is usually needed for the allocation in the next phase. So it's always good to have some sense of where, what are the companies that we can compare the subject company to. The matrices that we used, those are the multiples. We use multiples. The most used ones are revenue and EBITDA, but it can also be net income or book value. Some of the multiples are really relying on the equity value. So for example, net income and book value of the equity are being applied on the equity basis. The EBITDA and revenue multiples are being applied on the enterprise value of the business. The enterprise value in the numerator is the market value of the equity plus the value of the debt. Let me just maybe jump quickly and show you a numerical example. I think it's probably going to be easier. So let's say that we identified a public company and the equity of this company is $50 billion. The company has a debt of $25 billion and its trailing 12 months EBITDA, TTM is trailing 12 months, is 7.5 billion. The implied EBITDA multiple for that company is 10. That's the value of the equity, 50, plus the value of the debt, 25, divided by the EBITDA of 7.5, and that derives a multiple of 10. Now, for our subject company, let's assume that we have a trailing 12 months EBITDA of 10. The implied enterprise value is 10, that's the multiple, times the 10 million of the EBITDA. So the implied enterprise value is 100 million. If the subject company has a debt as of the valuation date of 10 million, the implied equity value is the enterprise value minus the debt. So the enterprise value, that's really the value that's being derived from those cash flows that we discussed earlier. That's the value of the operation. So the enterprise value is also being referred to as the operational value or the market value of invested capital. So that doesn't include any non-operational assets, but it is including the equity as well as the debt. It is important to note, like as I mentioned earlier, that the subject company is usually different than the company that we analyze. So even if we find that those companies that we use as good comparable, we still need to consider a few inputs and consider doing adjustments on the raw multiple that we calculated. So that includes a size, profitability, and growth. So the bigger the company, the lower the risk is. The more profitable the company, the lower the risk is. And the higher the growth expectation of the company, the more investors will be willing to pay. So bigger is better, more profitable is obviously better, and growth expectations, the higher the better. Many times when comparing, a company to public companies, especially for new companies or relatively new companies, we need to, consider that size and likely profitability will imply lower multiples. On the other hand, the growth expectations of the subject company will likely be much higher. So sometimes it is offset, sometimes it doesn't. I have to be honest and say it's many times subjective and based on experience and just how we see the company compared with those companies that are public. There is no set of rules that says this is the adjustment that you need to make, but this is something to keep in mind. So like I mentioned, the approach is often not applicable for at least early stage companies because they either do not have revenues or profits, or even if they do have revenues, they're so low that it's really difficult to take a multiple even from fast-growing public companies and apply to a company to derive a reasonable value. Like I said, it is good to take a look because it gives us an indication if the exit multiple is reasonable. Even if we do not use exit multiple and we use some other method, you can derive and imply the exit multiple from that, see if it's relevant. One of the things, we would derive from, similar companies is potential volatility, which is one of the inputs that we'll use for the option pricing method that will be discussed later. But just as a tool to value the equity, it's not always the most relevant approach. So the other method, the market approach, is the guideline company transaction method. Under their approach, if we do find transactions, either of public companies or non-public companies, and we have enough information from those transactions, we can derive how much someone was willing to pay for a similar entity. And exactly in the same way, we can take that value that was paid and extract revenue multiple or EBITDA multiple or any other applicable multiple depending on the information that we have. However, the issues are obviously lack of data regarding the target and the purchase consideration. Not all the information is always available, even when two publicly traded companies are involved. Acquisition price many times reflect a premium or synergies that the buyer is willing to pay that might not be relevant when analyzing the company that we're valuing, especially when the analysis that we're doing is on a minority basis. One thing that was probably should have been explained earlier, when we do the DCF, the cash flows, we have two ways to do it. Since we're valuing a minority interest, we just value one share. We do the analysis on a minority basis. One way to do it is really to forecast to begin with on a minority basis. This is what at least we usually do. The other way is to do it on a control basis, but then apply discount for lack of control. In this case, obviously, in those acquisitions, there is a control premium being baked in, and we don't always know how much was paid for that control. And are there really enough transactions that are truly comparable? Even if we find one, it's not always useful. So the methodology of how to extract the multiples and apply them to the companies is similar to what I showed you with the guideline public company method. Lisa, are there any questions you think I should address now?
Not at this time. I would feel
Okay.
free to wrap up, and we can save the last few minutes for any general questions.
Okay. All right.
Thank you.
So let me just move quickly. So we have the option pricing method backsold, which is really the best for most early stage companies. And let me jump on the asset-based and just know that really the approaches that we end up selecting really depends on facts and circumstances, and we will consider all and apply the relevant ones. The equity allocation, that's really where we take the value of the equity and allocate it between the different equity groups. We have what we call the option pricing methods. That's the method that is being used to allocate the value. The value of the company, really the equity, is being broken down based on breakpoints in equity values in which the value change hands. Let me just show you a quick example here. So after building the waterfall, we have breakpoint 1. So we have a company that was actually not done for 401A purposes, but we have Series A, common, and warrants. Before breakpoint 1, Series A, which is preferred, shares all the benefits. After breakpoint 2, if the value of the equity will exceed that, only common will receive value until it matches Series A. Then they both share until the first bunch of warrants comes in, and then the second bunch of warrants. For each of those tranches or breakpoints, we apply Black-Scholes. Those are the inputs that we apply. You see here the volatility, the last one, that is usually based on those companies. Hopefully we can find enough companies at least to extract that information. And then the value in each of the tranches is then being allocated between the different share groups based on what we've seen earlier. So breakpoint 1, 100% go to Series A, breakpoint 2, 100% to the common. And this is what we do during all the stages. At the end of the day, we concluded that Series E as of that date is worth, as a group, 16.7 and the common 10.7. And the last phase is to apply a discount for lack of marketability. I noted earlier that the final step is really to take the value that is being calculated as freely traded basis, meaning if you can freely trade, if you have liquidity, since we're valuing security in a privately held entity, we assume that liquidity will be lower, and there are quantitative and qualitative methods that can be used to estimate the discount. I'll open the floor to questions now, but pretty much what we covered today is why a Section 409A valuation is needed, what you should expect from the appraiser, and why you need an appraisal being done, and the applicable method that can be used to value the underlying security. And I believe that Lisa will also share the presentation, and I'm happy to answer any questions also after the presentation, and just feel free to reach out.
Thank you so much, Lerone. Super helpful and insightful. Folks, there are no questions in the chat, but feel free to unmute yourself. We have about 6-7 minutes left till the top of the hour, and would love to take advantage of that. So does anybody have any follow-up questions?
I do.
About it?
I do.
Go right ahead.
So you grant your employees some shares for services in trade, basically their salary, because there is no money to pay them with. But then what is the value of the shares, or when do they have to pay taxes on it? When they sell it?
Yes. So once the options are being exercised, and that's when it will trigger the taxable event. So the thing with the deferred status is that you do not pay tax. Obviously the election has to be made, but as long as the election is being made, and as far as I know it's usually being made, tax won't be paid when the options are being granted. Obviously, that is important, because in the case where those options are not being exercised, because they do not have value.
But the value of it, if today, would be, say, 5 cents, I guess. Is that what you go on? Because if the company is not making any money, you have no income or no valuation. You would just go by maybe on what investors put in and come up with a figure that way?
Yes. So that's the valuation process that we're going through. So even a company that does not have revenues still has value. So we either build those, or the company build those projections, and those projections are being used as a basis, or in the case that there is a financing round, then we use that financing round to derive the value of the underlying security. So it's not always the same security. There might be a financing round for Series A. You will grant options for common, but we can still use that financing round to derive value. But yes, the whole purpose of a 409A valuation is that even though it's not a publicly traded company and you don't have a market value for the securities, the company has value, and we're doing that process in order to derive the value of the underlying security.
Thanks, Mark. A couple questions in the chat, Lerone. If you haven't done a price round yet, do you need a 409A? And then if you do one, how often does it need to be completed? Is it after each financing round? Does it need to be updated? So those two questions are currently in the chat.
Yeah, I mean, it's actually those are separate. So the financing round can help, establishing a value for the company and the underlying security, but you can grant options without having a financing round, and you can have a financing round without granting stock options. You need to do a 409A valuation only if you grant stock options and you want to have a safe harbor status. So, and I think I mentioned earlier, it should be done probably within, the valuation date should probably be within 2 to 3 months from the grant date. But again, you can grant options and not have a financing round, or vice versa.
And then the next question was, how often do you have to do one?
So it's only when you grant it. So if you grant options just once and that's it, you just need to do it as of that date. If you have a plan that the options are not vested but granted over time, then you have to do it around each grant date. So let's say that an employee is receiving $100,000 options, but instead of receiving all the grant at once, you split it into dates. You have to do each date. You have to do an analysis. Usually, it's not how it's being structured though, but in those situations, you have to do it for each grant date. If you just grant the options once and it's just being vested over time, you don't need to do it more than once.
Okay, terrific. And another question: how do you value issued non-licensed IP in a pre-revenue company?
So that is not directly related to the 409A. I mean, it really depends what the asset is. I'm happy to learn more, hear more about the specific question, and maybe I can provide a better answer. But it's not related to the 409A. Part of the value of the company is obviously the IP, especially in technology companies, bio companies. Really, most of the value is in the intellectual property, but the analysis doesn't really break down the value of the company to the different intellectual properties or intangible assets that a business might have. It's just being valued as one cohesive group of assets.
Awesome. Okay, and then just to clarify before we wrap up, for your former answer, so if you're raising money on a safe or a convertible note, you don't need a 409A valuation.
No, if you have a pre-seed round or seed round or a safe note round, you do not need to do a 409A valuation. The purpose of the 409A valuation is specific to achieving a safe harbor status when granting stock options. If the options are being granted around the time that you did have that financing round, that's actually good, because we can take that financing round and extract the implied value of the equity, and from that the implied value of the underlying asset that is being valued. But the safe round itself does not require, I mean, the IRS doesn't require you to do a 409A valuation when you issue safe notes.
Okay, perfect. Thanks for the clarification. Well, at that, we are at the top of the hour. Time moves fast when you're having fun, as they say. Thank you for everyone for joining us today. Liron, huge thank you to you. Such a hot topic, such an important topic. It can certainly be confusing to some. We will circulate the presentation. Liron, if you could send that to me, that would be great. And the recording, so look for an email later today. I've included in the chat our website. Check out our events page for upcoming events, workshops, and webinars. And of course, the best way to stay in the know is to follow us on LinkedIn. So Thank you all so much. Happy Monday. Enjoy the beautiful weather. Take care.
Thank you, Lisa, and thank you for everyone.
Thanks, everyone.